Good morning or good afternoon, depending on what side of the country you're joining us from. Charlie McQueen, President of McQueen Financial Advisors. Really excited today to continue our webinar series now into 2025. And today we have actually an incredible webinar. I'm super excited. Two of our awesome leaders here to talk about navigating ALM strategies for financial stability, which in this day and age, not a lot of stability out there, so it really does help. So with that, I want to thank my two presenters for joining me today. As we go to the next slide, a couple quick housekeeping. Oh, sorry, I'm sorry. Start off with Heather. Heather Shepley. Heather, we're super excited to have you here. Heather is responsible for all data and fun things related and modeling of everything. Heather, incredible team member, working with us for a long time. Heather knows everything about ALM there is. Heather, that's not quite the bio they gave me to read, but it's my version. So thank you very much, and great to have you here.
Thanks for having me, and thanks everybody for joining us.
All right. Also joining Heather, Matt Behar. Matt is one of our senior advisors. Matt has been a part of the company for a long time and one of our East Coast gang. We have our Bloods and Crips, depending on our East Coast and West Coast gang here, but Matt's part of the East Coast gang. And we're excited to have Matt join us today. Matt's been an advisor for many years and has incredible knowledge of asset liability management, great strategy and strategy implementation. So Matt, thank you very much for joining us today.
Thanks, Charlie. That summed it up pretty well.
Yeah, I don't know why they give me these bios to read. It just kind of gets skipped. So thank you. All right. Well, with that, then now we'll go into a few housekeeping things. I've jumped ahead of myself. Today's webinar is being recorded. If you have any questions along the way, a couple things you can do. You can click on the Q&A button on the bottom of your screen, ask the question. We'll either politely interrupt our incredible presenters or we'll ask them the question at the end of the webinar, whatever makes most sense given the question. Also, if you'd like a copy of the webinar, please reach out to your advisor and ask them, your MFA advisor, or you can always go to our YouTube channel or our website, which they'll also be located there. So with that, Heather, Matt, I'm super excited to be here with you today. Thank you very much for doing this, and we're all excited to hear from you and not me. So with that, I'll hand it off to the two of you.
All right, thanks, Charlie. What we're going to do is talk about just a little overview of what today may look like for our webinar. As Charlie had mentioned, this is part of our educational series. So today's focus is more that introduction, that 101, the concept of what ALM is. Why do we run ALM modeling? How do we perform it? And what are our main focus points of what we're looking at? And that pertains to net interest income and NEV, or net economic value of equity. So those are really the main focus points of what we're going to be talking about today, the two main tests that you're going to see in an ALM report, and just kind of an overview of everything we discussed today, and then a little preview for you into the 201 of what that next educational series would look like. And as Charlie had mentioned, please continue to send in your questions throughout the webinar, and we'll either answer them as we get to that section or at the end. So we appreciate the feedback. So Matt, our definition of ALM, what is ALM?
ALM is asset liability management, and we're dealing with the risks of having different assets and liabilities with different maturities, different rates, and at the same time, trying to focus on growing income while managing that risk.
Yeah, and many times with ALM, it's not the most intuitive concept. And so looking at those definitions, I'm an Italian. I talk with my hands. I like photos. I like examples of things. And this page really kind of gives you a good visual of the concept of what ALM is. And this is that art and mix of volume and interest rate sensitivity based off of your funding sources and your deposits or your loans and investments. And you can see that teeter-totter at the bottom. And that's really that balance of both sides of the balance sheet between our assets and our liabilities. How do they complement each other? So the liabilities, looking at, again, we're looking at interest sensitive items. So it's anything that ties to an interest rate. So when we look at our liabilities, we're focusing on non-maturity deposits, term deposits, and any borrowing structures that we may have. This also includes any sub debt that you may have as well. And then on the asset side of the balance sheet, we're looking at our lending, investments, and any of our overnight funds. So, as we look at the structure of a financial institution's balance sheet, there's kind of a flow that has to happen that we're testing. And what exactly does that look like for us, Matt? Is this picture perfect comes in and everything matches and then spits back out?
Sure. No, no,
We
no.
wish, we wish.
Yeah.
It'd be
No,
ideal.
typically or very rarely, the amount of money that comes into an institution, it doesn't match what goes out. So at different times, I'd say maybe last year, we were dealing with uh, institutions looking at ways to increase their funding needs. So maybe looking at ways to raise CD rates to increase funds. But now, recently, we seem to be dealing with many institutions are experiencing excess liquidity and developing strategies for growing loans when it's difficult to grow loans, maybe looking at loan participations or increasing investments, or even looking at alternative type investments, such as an employee benefit pre-funding account or charitable donation accounts. So it's definitely ALM deals with managing uh, that mismatch of money inflows and outflows of funds into an institution.
And that's the part I kind of like with doing this series on an annual basis because every year this conversation changes based off of what's going on in the market. And so when we look at our balance sheet, we claim ALM's more of an art than a science. Definitely want to channel my inner Bob Ross in regards to all of this, but everything is so unique to every institution. You have a different client base, you have different competition. The structure of your balance sheet between assets and liabilities may vary. So this is the great part about getting into the ALM is you have the science part is really just getting all of those interest sensitive products captured so that we could test it in the model. But once it gets there, that's where the art comes into play. We're looking at assumptions, we're looking at movements of the market, really kind of engaging of what that forward projection is. And that's where that art comes into play is how do we structure all of this and what does that look like for us? So why exactly do we run ALM, Matt? I know this is something that they ask us to do, and we're
Right.
getting into this and we're looking forward and looking ahead. We're looking at our earnings, our balance sheet position, definitely looking at historical trends of where we've been. But the idea is take that so that we can project forward to see what is going to continuously happen based off of where the market could go. And we really want to be able to handle different types of movements of the market and make sure that our balance sheet is structured in a way that is going to catch problems ahead of time. This is ultimately our goal is we know what's happened in the past, we know our structure of our balance sheet today. Let's try to project what that future looks like and making sure we're structured in a manner to be able to handle that. So I love this image, Matt. I got the crystal ball here. Somewhat pertains to kind of how we do this and how we look into the future.
Right. The ALM deals with managing or anticipating risks when market rates go up or if they go down as we're expecting. But in ALM, we are assuming that we're looking at no changes on the balance sheet. So it's also important to look at changes, look at what happens when your balances grow or decrease, and run different types of simulations or scenarios, different what if scenarios. I know we here at McQueen, we have our MFA, McQueen Financial Advisors Navigator tool, but we'll talk a little more in the upcoming slides about the importance of running these dynamic or what if scenarios.
Definitely some good opportunities there for that. And so I know for many, we run this quarterly. Is this necessary to do this often?
Quarterly is a good way to see the change as your balance sheet's constantly changing. So we want to continually evaluate the risk on your balance sheet uh, that comes along with having that different mix of assets and liabilities. So yes, is definitely prudent to run it on a quarterly basis to anticipate risk before things happen.
Yeah. Yeah, it's been very interesting, especially in the last couple of years of how fast the market can pivot and change. So constantly reassessing what that mix on our balance sheet is doing is usually very helpful for that decision making for the future. So, knowing why that we have to do this, but how do we perform this? This next section, we really want to get into, how we're going about this, what these numbers mean, and how we're implementing them. So We're looking now into the first of the major of the two tests, interest rate risk modeling, looking at net interest income. Matt, tell us a little bit about kind of, what are our requirements and what's our starting point of getting to these tests?
Yeah, typically an ALM report will be run at quarter end. So if we're looking at that, say December 31st, and we're running a static or no growth, assuming that the balances don't increase or decrease, and analyzing the risk as of that point in time. But as I mentioned, it is also a good idea to incorporate your budget or other types of growth assumptions in the form of what if scenarios to see the impact on the interest rate risk.
I love that we have this here and kind of pointing this out. And as you had mentioned, we'll continue to touch on some of the ways to use this in the future. But as a requirement, based off of the regulatory guidance, we have to assume this static balance sheet. So the second bullet point of just this static no growth is assume that all of those balances are going to stay flat over a 12-month time period. But we know that that's not reality. We know that there's movements in the market. We've got budget expectations. We've got lots of things that can impact and change the structure of our balance sheet. So as Matt had mentioned with our navigator and these what if scenarios or these simulations, this is a great habit to be in of using your ALM as a great baseline foundation of a starting point, and then really running some dynamic real world changes that could occur. Whether you are looking at doing different deposit specials or taking on borrowings or growing certain loan products or trying to diversify your investment portfolio more. Utilizing these tools to show both a baseline and that growth really gives us a really good picture of where we could go with this. So one of the first tests that we have to do is this shock scenario and this parallel movement of net interest income. So our standard structure is to start with a parallel instantaneous rate shock of 100 basis points. And what that means is we assume that if the market is going to change, we're assuming it's going to increase 100 basis points. So if the Fed decides that they're going to raise 100 basis points tomorrow, we assume that the entire yield curve, short-term, mid-term, long-term rates, are going to move in lockstep instantly with the overnight rate. So that's our first test that we want to do here. And a shock test assumes that it happens on day one and stays there for the rest of the year. And that's a great kind of worst case scenario test. But we also want to be able to see what happens if rates change slow and steadily over that 12-month time period. So in the McQueen model, we actually add in a second layer of a gradual test. And that gradual test is that slow, steady change over time. So what we're going to do is I want to show just an example of how those rate changes can happen in a shock test versus a gradual test. But again, we want to remind ourselves that we're looking at a 12-month forward projection, the same dollar amount, just at the current market rate. So if we look at this page here, this gives us the top section of a shock test, which is our regulatory requirement. And then the bottom is our gradual test, which we refer to more of a management tool. This is that slow, steady change that we would usually expect to experience in the market. And what does that impact to our income look like when that occurs? So when we look at this top section, you can see that we have our cash flow. We just used a baseline example of $50,000, our monthly cash flow that's expected to come in based off of that amortization. And the current rate is 6%. So let's assume if rates go up 300 basis points, that market rate is going to go up to a 1020. Now, in a shock test, the assumption is it happens on day one. So you can see right here in month one, that replacement rate becomes 1020. So every month of the cash flow that's coming due is going to move from our 6% starting waiting rate, and it's going to be replaced at that 1020. And then by the end of that 12-month time period, our ending rate would go up from 6% to 782. So this is that required test we have to do in this shock scenario. The nice part is, as you look at a gradual test, same concept of the change happens, but this is spread out over the 12 months. So what happens is if rates go up, from a 6 to a 10/20, it's going to increase 35 basis points every month over that 12-month time period. So it's not actually going to reach that replacement rate of 10/20 till the end of that 12-month cycle. And you can see that weighted rate goes up to a 698 here. So again, looking at both sides really gives us a good picture of a worst case scenario of rates changing instantly versus that slow, steady change over time. It really gives you some kind of two different views of how we can look at how we want to structure our balance sheet and what that impact to change of rates could look like.
Yeah, that shock is more the stress test where we're applying the entire change immediately,
Yeah.
and the gradual might be considered the more realistic scenario where we're moving rates more slowly, but still ending at that same rate.
Right. And so in a rising rate scenario on assets, you really want to reprice as quickly as we can. But in reality, right now, there's going to be some benefit to this as rates come down, where we can kind of still hold on a longer period of time of some of those assets. Those liabilities are going to reprice lower faster. So really having that good balance and understanding where those cash flows are coming on both sides will really help us kind of take advantage of what the market's giving us in rates right now. But it looks like we've got definitely some opportunities and some shifts that could be happening for us on the balance sheet with these forward projections. Matt, why don't you tell us a little bit more about what we can see here?
Sure. Here we're looking at, well, it's good to see we're looking at trends quarterly. So we're running ALM reports quarterly and looking at how the balances have changed in actually at the end of each quarter. And then our last column again shows our 1-year forecast, assuming no changes in the balances, so a static balance sheet. But as we're getting those loan principal payments back over the next 12 months, we're assuming they're going right back on the books in the same type of loan, just at your new current repricing rate, which in this case would be higher than the rates on your books, as we're seeing the weighted average rate increase from that 6.86% at the end of December to 7.19% in our 1-year forecast. On the investment side, same thing. We're seeing the investments as they're maturing over the next 12 months, repricing to higher rates. And we've seen that, as according to this trend, that's been happening over the last year, and we're expecting that to continue.
Yep, definitely some great opportunities with rates. Despite that flatter curve, we still have some great opportunities to really pick up some yield right now, which is important as we see some of these costs on that liability side are still a bit high, but it looks like it looks a little better than the trends that we were seeing last year.
Right. What we're seeing here, yeah, here are the trends. We're seeing non-maturities increasing, CD balances as well. They were increasing and then starting to decrease. And here we can see with the rates, how those CD rates were growing each quarter, or increasing, I should say, as institutions were increasing their CD rates. But now we can see from September to December, as some of those CD rate specials have stopped, or overall deposit rates have come down, especially on the CD side. So we see that weighted average rate on the whole CD portfolio decrease there. Borrowings in this example, we see that has gone down as we look at the trend information, and which is a positive thing because our cost of borrowings has decreased over time.
And this is a great example. I know I've seen a number of balance sheets really focusing on doing some simulations, showing some kind of shifts out of the focus point of term deposits back into non-maturity deposits. So again, we're seeing this reduction of our cost of funds. We definitely have some ongoing opportunities to continue to kind of reel that in a little bit as we saw a big kind of pickup occur, especially in this last year or so. As you see these numbers really increasing, we're starting to see this come back down a little bit right now, which is great, especially as we're picking up a little bit higher yields on those assets.
Right.
So net interest income, again, looking at that forward forecast, looking at our overall on all of these rate scenarios, looking at the mix between our assets and liabilities, our ultimate goal is really to disclose what this earning sensitivity of our institution is. So as we look at the combination of both assets and liabilities, again, we're focusing on just the interest sensitive products and seeing what the net of those two are. So this is just showing our loan interest income and securities interest income, which includes our overnight funds and any investments, whether that's our standard portfolio, EBPA, CDA. What is our net, our total interest income? And then from there, we're going to then offset all of our expenses on our non-maturity deposits, term deposits, and borrowings. Again, anything tying to an interest rate, and then that net interest income sensitivity. So this table here is showing our current, and this yellow band is assuming that it is the rates did not change in the market. We're still flat where we're at. That's our base case. And then we do those shocks as rates go up and down 100 basis points at a time, up to a 400 basis point increase or decrease. And this is our starting point of that test. So when we can see our numbers and we can see that income changing, the next layer that we want to put on this is making sure that we have built in some parameters of what that sensitivity is appropriate for our balance sheet. And again, back to that teeter-totter, the balance between both sides. We want to take on some risk because we want to be able to be profitable, but what's the proper balance between those two? So Matt, it looks like we have a little bit of guidance here, kind of showing us what we think is appropriate for our balance sheet. Does this really kind of help guide what those decisions should look like? Or does this kind of tell us that, we can just do anything we want now?
Right. That would be nice. It may, but this is what this example is showing. Again, we're looking at our NII net interest income forecast for the next year, assuming a base case that rates don't change for the next 12 months. And we're comparing that base case forecast to our forecasts in these different rate shock scenarios, assuming what happens if market rates increase by 100 basis points or 1%, or if rates go up by 200 basis points or 2%, or 3 or 4%, or if rates decline as we're expecting by 1, 2, 3, or 4%. How much does our net interest income forecast change? And is that change considered low risk? Is it acceptable in terms of your policy limits? In this example, we're seeing relatively small changes in the net interest income compared to that base case scenario in the different rate shocks. And all of the results are showing us that the changes, the net interest income sensitivity is within your policy limits, so would be acceptable.
Yeah, and one thing that we are seeing, and we see this a little bit more where we're actually being more profitable as rates go down. And a lot of this is because of those deposit structures are significantly shorter than we're going to see on that asset side. So we can really bring in that expense very quickly. So if rates do start to retract a little bit, there's definitely some benefit that we're going to see to that net interest income at the end of the day. So Matt, when we look at this and we do these tests, it looks like there's a couple steps here that we want to incorporate in any decision making, depend on what that information gives us. Is this an exercise that we should be doing when we go to run, or should this just be kind of an annual look? How do we want to approach this?
We should be evaluating this every time we run the ALM reports, and then on an ongoing basis determine which assets and liabilities are causing the greatest changes to the net interest income. Is your institution comfortable with the changes that we're seeing in terms of the net interest income forecasts, or are any changes warranted to bring things back within policy limits or back to a level that is acceptable?
Definitely something that needs to be assessed often as things are changing so fast in the market. For many years, it was a little quiet, but that has not been the case recently. So definitely something to keep an eye out for. And that impact to income is the first test in this interest rate risk view. And so definitely an important piece. So now that we've kind of covered that interest to income impact, now we want to pivot over to value. This is net economic value of equity, or NEV. And basically what this is this is a snapshot in time. So whenever the report is run, it's valuing our entire balance sheet in the market as of that day. What did the market offer us? And what is the value of our balance sheet in this mix? So what this does is it takes the market value of assets and removes the market value of liabilities and giving us the net of those two things to tell us what our equity may look like. And what we use to do that is our principal cash flow. So looking at all of our loans, investments, deposits, and the value of what that cash flow may look like. And then the interest that's tied to that. What is that coupon rate? That's an impact to what that value is in comparison to the market. And the maturity date or the duration of that product is going to be very impactful. And then discounting that to the market. We look at everything, starting point of looking at our treasury curve. What is an equivalent in the market for this product? How much value does that product hold? And when we talk about the treasury curve, it's definitely a piece that we want to look at of where that position is, because that impact to our value is really driven off of what opportunities we have here. And Matt, it doesn't look like there's a ton of opportunities depending on how much duration this is looking at. What is this treasury curve doing to us right now? How's this
Yeah,
look?
it looks pretty flat from my eyes. No, this is what we've been seeing for a while now. I mean, typically what would we would like to see is this dotted black line on the bottom, more of a normalized or upward sloping curve where as you go further out on the curve or invest for, say, a longer period of time, you're rewarded with a higher interest rate. But that's not what we're seeing. That's not what we have seen lately. We're seeing more of this almost flat. You're starting to become a little bit more normalized with those higher rates, get higher rates for the longer term points, slightly higher, but relatively flat still. But we are seeing some of that inversion that you're circling there with the, the short part of the curve, or the shorter maturities having the higher rate of return than the longer maturities. And it definitely has an impact when we're doing, as you mentioned, Heather, on the prior slide of the discounting or comparing the rates that we have on our books. And when we run the ALM model to these current market rates, we get some interesting, sometimes counterintuitive results.
Yeah, for a while there, some short end was showing a ton of value, especially in the liability side, but we're definitely seeing that starting to level off a little bit. So, as Matt had mentioned, when we're looking at NEV and then impact, duration is really a big driver on how NEV sensitivity occurs. So, this visual here kind of gives you the view of three different types of durations, whether it's long term, as you can see, the top row here is a 30-year mortgage. That's generally one of the longest products, especially on the asset side of the balance sheet that we may carry. That's going to hold a little bit more risk because it's locked out for a longer period of time versus a midterm item such as an auto loan, which is usually hovering somewhere around 4 or 5 years, or even your overnight funds that move immediately with the market. And what we're trying to establish is how sensitivity is impacted based off of the cash flow or how long these products are. So when we're looking at a 30-year mortgage, you can see as rates go up, that sensitivity or that value is going to go down, because if rates are increasing, there's higher rates of those loan products in the market. So what we're carrying on our balance sheet isn't worth as much. Now, as rates go down, the opposite happens, or as a general concept, the opposite occurs. As rates go down, what we have on our books probably is at a higher interest rate than what the market is offering in that scenario. Therefore, we get a premium because these are worth more than an equivalent replacement in that market. And the shorter the duration is, the less sensitive you're going to see these numbers until you get to an immediate cash overnight, which is going to be the exact same value as that moves in lockstep with the market. So there is no premium or discount you may see with those liquid types of products, but definitely showing more impact when looking. The longer the duration is, the more sensitivity you're going to carry. Now, this is the asset side, which if the bigger the number is, the more value that holds or a premium. Now, when we look at the liability side of the balance sheet, this is the part that can be a bit counterintuitive. And the concept here is whatever the number is going to be reduced from the assets, giving us a net economic standpoint or net capital value. So the smaller the number is, that's actually a premium when we're looking at the liabilities, and that's going to leave more value at the end of the day of our balance sheet and giving us a higher position. So when we look at liabilities, we're seeing a midterm, long term, an overnight, and just showing the sensitivity here. And it's going to see that same concept. But again, a reduction in a number is actually a premium because you're taking less away from those assets and vice versa. So it's definitely one of the more difficult concepts to wrap your brain around on the liability side of Neve. But when we look at the big picture of the entire balance sheet, this is kind of that net value or impact of what this may look like. And this is a great example of a fairly flat, stable Neve position. But one piece I did want to bring up, and we're going to touch on this in a few slides, is this non-linear value as rates go down. This is caused from our non-maturity deposits. And this is due to already starting at a very low rate and not having a lot of room to move in the market. So we're going to talk a little bit more about this here in a few slides of what may cause some of this non-linear look, especially in the down scenario. So, Matt, when we have this output, again, we did an exercise earlier with net interest income. It looks like we have somewhat of a similar framework for value. Should we be looking at this in that same way?
Yeah, it's a very similar analysis. We're looking at, again, a base case forecast where we're looking at current rates, and then we're seeing what happens to the net economic value if market rates increase or decrease, and is that percentage change from that base case within your policy limits. One thing to note is that net interest income was a 12-month forecast where NEV is a point in time measurement. So we're assuming that say for this example, December 31st, as of December 31st, 2024, market rates immediately go up this 1, 2, 3, 4%, or they immediately fall, and your ALM model will recalculate the market value of your equity or your net economic value as opposed to income, which was a forecast. Again, here in this example, we're looking at those percentage changes from that base case, seeing that they're within the policy limits. They're telling us we have low risk changes on our balance sheet, and this again is a tool to look at, telling us we have the ability to take on some more risk if that's what we would desire to do in order to grow income, to see how the impact on NEV would still be considered acceptable.
Matt, I love the fact that you bring that up. You made the comment about being able to take on more risk. We don't want to mitigate risk completely. We want to have some risk here because, like Matt had mentioned, we want to be profitable. So I like this checklist and this kind of approach that we had looked at earlier. We're going to apply this in that same way. You know, this tells us that we have some flexibility to maybe try out other things or to test to see what our balance sheet can handle. Are we able to use some of these things to help drive some of those test cases or decisions of what we may want to do in the future?
Yes, and that's how ALM is giving you that snapshot of a point in time. You're running that on a quarterly basis and seeing what your risk position is. Then we'll look forward using that crystal ball approach and run some of our what if scenarios or simulations to see how risk would be impacted if you're taking measures to grow income. Is the risk to your net economic value also acceptable?
Yeah, and that's the great part with all of this is we can test, we can, shock the balance sheet, we can move things around and really see what those opportunities are. We want to maximize what we do, but we also want to be within limits and within a healthy range. Hence the guidelines of these test cases, these examples, the questions to ask, and really monitoring what our policy is giving us and how much room we have to be able to, test different things out. So earlier we had mentioned the possible nonlinear impact of some of our value. And the reason why we're seeing this is because the influx of cash that came in during COVID gave us a ton of overnight funds. And this was great for a long period of time until we saw rates start to increase, overhead get much more expensive, and we started to see these deposits run out the door. Well, as that occurred, one way to try to mitigate our expense on deposits is by focusing on doing different maybe deposit specials that are more driven off of term deposits. We can control the dollar amount of the expense that we're doing. And as that occurred, we had found that most of the increase of our expense was driven from our term deposits and borrowing structures. So we saw that a little bit earlier as we saw some of those rates really come up, but now they're starting to come down a little bit. As that occurred, that kept us from having to be forced to raise our overnight funds rates or our non-maturity deposits nearly as quickly. Actually, for most balance sheets, we didn't really move non-maturity deposit rates at all. And if we did, it was generally only on one or two specific types of products, such as reward checking or more rate sensitive things such as IRAs or money markets. So in turn, the core of our non-maturity deposits have continued to stay at a very, very low cost. And you can see this example here. We're only paying 5 basis points on checking accounts and 10 on savings. So if that's the case and rates go down, we're going to floor out our rates at say 1 basis point, for example. Well, if we're starting off only at 5 or 10 and rates go down, we're going to floor out that rate very, very quickly. So essentially what this is showing is the fact that our reduction of our expense and that equivalent value in the market is going to floor out really quick, and it's going to stay and hold there the rest of that test. So as rates go down 1 or 2 or 3 or 400 basis points, we can't reduce our costs anymore, especially on that non-maturity deposit side. Therefore, the changes in value is really showing kind of this nonlinear movement. And most of this is driven because of these very low cost non-maturity deposits. So it's definitely a piece that I want people to recognize that that is usually the cause of why you're seeing some interesting shifts that are occurring. Most of it's driven from that. So definitely something we've been seeing a lot of, not necessarily a bad thing. It's nice to have those deposit costs nice and low, but definitely something to keep in mind on how you structure the other parts of the balance sheet in these down scenarios.
And this is the correct way to model it. You wouldn't want to model negative rates, assuming that rates fall 1, 2, 3, 4%.
Yep.
But as Heather mentioned, there is room for the loans and investments to fall by those amounts. So that's why we continue to model those scenarios.
Yep. Yeah. And for some on that net interest income side, there's definitely seeing some nice boost to income as rates go down because you are flooring that expense so quick. So that is another benefit of some of these scenarios that we're seeing. So it's a very, very common thing that we're seeing on a lot of balance sheets. So we talked a lot about net interest income, talked a lot about NEV. And so as we look at these two things, we know value on a flat curve may not give us as much of a boost as we hope to see. So you may see some more kind of flat positions. And then we're also seeing some unique things happen on that income side. Definitely seems like examiners seem to be very, very focused in kind of this aspect of how we test the balance sheet. Man, I know we talk with clients all over the country. We're seeing lots of different things. What seems to be that major focus this year that's a little bit different than maybe we have seen in the past years, just based off of what the market was giving? We're definitely in a unique scenario right now, and it seems to be a big focus in this world right now.
Right. We know everybody loves preparing for their exams, and and using ALM reports is part of that preparation, whether it's the FDIC or NCUA. They are concerned with ensuring your deposits, so they want to make sure that you are a healthy financial institution. And again, using ALM reports is one way to do that.
Mhm.
And specifically here with credit unions, the NCUA each year comes out with their list of supervisory priorities. And this year we see the second priority right there on the list is ALM related, balance sheet management and risk to income or earnings and net worth. And that's exactly what we've been talking about for the past 40 minutes here, how to manage those things using your ALM tools.
Yep. And it's nice that you brought this up. I mean, one major thing is obviously the balance sheet management and that risk to earnings. And that first bullet point being that credit risk. This is a big piece to make sure. And again, using our navigator tools to help guide some of this. With credit risk, we are concerned. Losses are starting to pick up. They are picking up at a fast pace, but essentially they're kind of coming back to more normalized ranges. We are seeing certain types of asset classes a little bit more risky than others, such as credit card debt, and we're definitely seeing some pickups on the auto side as well as we look at CECL. But as we're doing this risk management to our balance sheet, we want to take those things into consideration and we want to be able to price our products appropriately. And we do have tools on the Navigator to help drive some of that decision making, but these are the things that we want to consider when we're looking at that future projections. How do we price our loans? Are we doing this appropriately? Are we managing the risk of some of the losses that we were continuously incurring? Because that is a hit to our balance sheet, that is a hit to our net income, and that is going to start to bring some of that net worth, make it a little bit more challenging. So definitely some of the things to monitor and make sure that we're structured to handle and doing the best that we can to really continue to be profitable in this combination of things that's going on. So, Matt, it seems like it's a bit of a trade-off, depending on how we want to structure our risk and how we want to structure our balance sheet. Looks like we have some opportunity here on how we could go about it.
Right. ALM again is all about managing that risk of adding, say, risk on the net economic value side to grow income, as you showed in a previous example, adding those fixed rate, longer term, say 30-year mortgages. If market rates increase, those will drop in value. Yes, you are getting higher rates in the current market, but you do want to manage that risk of having those longer term assets on your books while continuing to grow income.
Yep. How far do we want to tip that teeter-totter, and what can we do that keeps us within a healthy range is really important. So, and Matt, and how do we do that overall assessment?
Well, policies are definitely, as we've seen, setting policy limits that are acceptable to your institution. Uh, again, they'll vary from institution to institution, but you want to run your ALM reports first, take a look at the results. I would, instead of blindly setting policy limits, see where you stand and have a conversation, whether it's your board has a discussion, your management, or there's an entire committee, an ALCO, divided to looking at ALM results and again determining the proper mix of assets and liabilities and what your strategies are going forward to ensure your uh, future success.
And that should be institution specific. Those policies need to be established that are appropriate for us because every balance sheet structure does look different. So what's appropriate for somebody next door may not be appropriate for us. So as Matt had mentioned, is really understanding what the structure of balance sheet looks like first, and then reviewing the policies to make sure they're appropriate for what our goals are and the structure of the balance sheet itself. So as we look over ALM as a general statement, we don't want to think of ALM as a regulatory burden. This holds so much value. We can see the impact of new products. We can run simulations. We can test these pieces out. We can assess whether or not we can take on more, or maybe this is too much for us and we shouldn't be doing those things. We want to be proactive. We want to not have to react later on, and we want to be able to be prepared. So as we had mentioned earlier, that crystal ball in the future, we're doing the best that we can to see what is to come and to be able to kind of test our balance sheet to identify what is the most appropriate way for us to handle that, to continue to be profitable, to continue to be at a proper risk level that's right for our institution. So there's definitely some great ways that you can use these tools and really help be strategic for the future.
Yeah, I like that last sentence about being proactive. So whether market rates go up or down, we're going to be prepared.
Absolutely. We don't want to react after the fact, then it's probably too late. So, all right. So just as a little kind of preview of what's to come in our 201. So our first run here today was really focusing on the high level concept of what ALM is. As we look into our 201, that's going to get more into more of the art side of ALM, which is getting into the assumptions. So we really want to make sure that we make sense on our loans. Again, looking at our loans, investments, deposits, and borrowings, the growth patterns, our replacement rates, how fast we reprice items, how fast we have prepayments that occur in lending, or our retention terms that we see in our deposit side. This gets into the assumptions that you're going to see embedded into the actual model itself. And again, more that art side of ALM as we make those assumptions for the future. So, Charlie, did we have some questions come in for us?
Yeah, I've got a couple questions that came in. And first of all, wonderful presentation. Thank you very much, Heather. Thank you very much, Matt. Really appreciate your advice. ALM sometimes can be a daunting and boring topic, maybe I should say, and you have made it interesting and insightful. So thank you very much. Quick question here. What are the best practices for back testing regular simulation results? And further goes on. So the question is, what are the best practices for back testing regular simulation results? Do we simply match up actual economic movement versus simulation results at a point of time? What time frames should we look for? So multi-part question there. What's the best practices for back testing? Do we match up actual economic versus expected? And at what point of time?
I'll take the first part. Since we're looking at a 12-month forecast, say we're doing this December 31st, 2024 ALM report, we're looking at your net interest income for January through December 2025. So once you get actual results at the end of 2025, you compare your net interest income to the forecast in your ALM reports. And since we're assuming a static, but no growth, no change balance sheet, the differences are going to be a lot of them in the balance as well as the rates, because in reality, they change over the course of the year. So we identify that. And as far as which scenario, you would also look at how market rates actually moved over time. So it is definitely good practice to run back testing reports annually.
Yeah, Matt, and that's a good point on when we do that test and we are comparing and we are incorporating the actual changes that occurred. Another test that I actually encourage institutions to do is as we do run simulations and we are preparing for that future, if we're looking at testing out or say do a loan special or we want to do something in particular, and then we end up doing that, that may be another great output to compare what your actual was compared to what the simulation was based off of those expected or hope changes that you're going to do over that time. So as we do run a back testing report, we have to start with the baseline of that static balance sheet, but then we can also compare that to a simulation we may have ran in that same quarter, see how close were we on those projections? Did we actually experience what we were planning for or what that budget may have told us? So it really kind of helps us fine tune what we want to plan for and incorporate into that balance sheet to see how close that we are over that time period, especially when we're looking at that 12-month forward projection.
Really appreciate the answer, both of you. I'm a bit old school, so I answer things a little differently at times. I like doing December 31st, just so it's an easy year over year type change for me. And it's more of what we projected versus reality. And economic updates, interest rates is what I look at as mentioned. So that's the way I look at things. Another question came in that it's a combination question statement, so it's kind of something that I would do. So I appreciate the question. It's asking if my interest rate risk position today says that I do poorly, I'll make less money in a declining interest rate environment. What are some of the strategies that we can take to implement? And obviously, I'm gonna have to throw a scenario on here for Heather and Matt without knowing the balance sheet. It's always difficult, but maybe say someone has a lot of cash in their balance sheet today, and things don't look that good if interest rates decline. What are maybe an example of a recommendation you'd have for that situation?
Well, I'd say before rates decline, lock in some of today's higher rates, maybe go a little further in terms of investing, so that when rates do fall, you have those higher rates on the books. That's one strategy.
Yeah, if you got a lot of cash on hand, definitely want to look at where we can put that money to work. Ultimately, that goal is we want to maximize what we can make today to protect us as rates do go down. So whether we are reinvesting that, we're expanding out to EBPA or CDA, we're looking at some loan participation pools, or really making sure that our cost is structured in a proper manner. We can maybe turn over some of those term deposits into non-maturities that are going to be a little bit less expensive, kind of protect as rates starts to drop and some of the income may go with it.
Yeah, great points by both of you. I think it's an interesting issue. Today, just you both said when rates drop, which I love. It's because the forward yield curve actually shows rates dropping somewhere around 50 basis points to 75 basis points this year, depending on what time you run the chart right now. So the market is predicting a little bit lower interest rates. So I do think that was a great question, as I do see a lot of ALM reports where people are performing quite well if rates rise, but not so good if rates decline. And it really is an interesting time, and I appreciate your answers. And one of the things too we can talk about is non-optionality based investments too, and making sure we're buying things without calls, non-amortizing, things like that, so we can lock in that yield. Because if rates come down, we have a limited amount of yield that we can see our cost of funds come down, a limited amount of reduction of cost of funds that can take place. With that's the last of our questions. So I always like to do this. Matt, do you want to ask Heather a question and just throw her left field out there? Or are you feeling okay at this point?
I'm feeling okay. I'll take it easy on Heather today. She's
Oh, thanks.
Yeah. But now Heather's got a 5-page question for you, Matt.
I'm sure.
No.
Let's get started.
Anything the two of you would like to add before I wrap stuff up? Oh, hold on, we got one in here, another one in here. Does the model incorporate CECL? If does your model incorporate CECL if you have what if scenarios that grow your loan portfolio? Will it change the CECL numbers?
Yeah, right. If you're I think they're almost answering their question. If you're growing loans, your CECL amount should increase. If the pool of loans, since CECL is looking at your different loan segments, if you're growing one loan segment and you're reserving for that one segment, the reserve would increase.
Yeah.
But in terms of the different rate shock scenarios, it would be captured in, say, other expense. You wouldn't be shocking the CECL amount.
And actually, Charlie, I love that question because we actually have a couple different ways we can go about this. As Matt had mentioned, the balances, if you're planning on running some increases or changes with that, if your historical CECL value is, say, 1% of loans, that CECL reserve is going to increase with it and it's going to account for that 1% of loans with those changes. But we've actually implemented into the Navigator the ability to make non-linear dynamic changes to those scenarios in the up and downs. So when you get into the net income side, we can go right into the CECL value and state that if rates continue to go up or they continue to go down, we can change that impact to CECL in a dynamic way. So you can do those in two different aspects. So there's definitely some options on how we can incorporate that, and we can see what that impact would be in each of those rate shock scenarios.
Heather, I really appreciate you bringing that in. That is great. Those of you out there who haven't been in the Navigator and checked it out, the MFA Navigator, it's extremely detailed. It ties in your liquidity to your ALM and CECL, and just everything comes together nicely. It's a great spot to run what if scenarios. Your advisor's happy to run them also, but if you're kind of like me and you wake up at 3 in the morning, you want to think about something, it's there for you to play with. So really, really cool stuff. And one thing I'm really excited about coming up in, got to look to my left here at the other calendar, on my calendar on April 16th, we have actually a webinar that we're going to do on the Navigator, showing you tips and tricks there. I'm really excited about that. So that's coming up. But before that, we do have our coming up here on the 8th, Investing for Growth and Purpose, Smart Strategies for Success. It's going to be a webinar about investment advisory services and investment management, I should say. So really excited to have both of those coming up here. But I'm super proud of the Navigator and the work that Heather and her team and our tech team have really done. Some great things there and some great changes coming along the way. And so please go and check that out. Without further ado, I wanted to thank Matt. Thank you very much for joining us today. Really appreciate your insight.
Thank you.
And Heather, thank you very much as usual. Your insight is incredible, and your attention to detail with the whole ALM, CECL, and data structure is very impressive. So thank you, Heather, very much for being with us today.
I appreciate it. Thanks, everybody, for joining us.
Thanks, everyone. Have a wonderful day. And again, please reach out to your MFA advisor if you'd like a copy of this webinar. It'll also be on our website. Have a wonderful day.